Hi guys, welcome back. We are now in profitability ratios under financial statement analysis. Quick recap. Financial statement analysis techniques include horizontal analysis, vertical analysis, and ratio analysis. Under ratio analysis, we will find profitability ratios. When we say profitability, means the ability of an entity to earn. Hence, profitability ratios measure the ability of a company to generate income, that is, profit from its operations and invested capital. There are different sets of profitability ratios. Let's go to the first set. This includes the following: gross profit ratio, calculated as gross profit over sales revenue; operating profit ratio, that is operating income over sales revenue; and profit or net income ratio, which is equal to net income over sales revenue. Collectively, this set of three is called margins. They're also known as the margins. They measure the operating efficiency of the entity. To demonstrate how they are calculated, let us refer to the following case. PRW Corporation issued the following income statement for the year 2020. Sales revenue, 1.5 million. Cost of sales, 500,000. Gross profit, 1 million pesos. Operating expenses, 200,000 pesos. Operating income, 800,000 pesos. Interest expense, 300,000. Net income before tax, 500,000 pesos. Income tax is at 20%. That will give you 100,000 pesos, giving you a net income after tax, 400,000 pesos. Let us calculate the following: gross profit ratio, operating profit ratio, profit or net income ratio. Again, they're also referred to as margins: gross margin, operating profit margin, and the profit margin. Gross profit ratio. This is equal to gross profit, which is 1 million pesos, over sales revenue of 1.5 million pesos. Operating profit, this is equal to the operating income of 800,000 pesos divided by 1.5 million pesos, the sales revenue. Profit or net income ratio, that's 400,000 pesos, the net income after tax, over 1.5 million pesos, the sales revenue. Gross profit ratio is 66.67%. Operating profit ratio is 53.33%. Profit or net income ratio is 26.67%. How would we interpret these figures? Again, margins measure the operating efficiency of the company. So, in interpreting these ratios, we would have the following. For every 1 peso sales revenue generated, 67 centavos goes to gross profit, 53 centavos goes to operating profit, and 27 centavos goes to net income. This is how we would interpret the margin ratios. Remember, they measure the operating efficiency of the entity. They tell us how profitable the operations, as represented by the sales, are. what percentage of the sales would go to the respective profit figures measured. As for the second set of ratios, we have the following. Return on assets. This is calculated as operating profit multiplied by 1 minus tax rate divided by total assets. Return on shareholders' equity. This is equal to net income or earnings divided by the shareholders' equity. Return on common equity. This is equal to net income minus preferred share dividends divided by the common equity. Collectively, this set of ratios are called returns or return on investment. They measure the investment's profitability. Take note that we have a different profit measure in the numerator for each of these ratios. This is to be consistent with their denominator. For example, total assets are funded by both liabilities and shareholders' equity. So the profit measure that would be relevant for both debt and equity would be the operating profit after tax. In other words, interest expense should not be deducted yet. This is because interest expense is the profit that is payable to the debt participants, to the holders of bonds, for example. As for the return on shareholders' equity, it will be the net income or earnings that will be the relevant profit figure. This is because the denominator is only the shareholders' equity. The shareholders' equity participants would receive the net income after interest and taxes. Lastly, the numerator for return on common equity is net income less preferred share dividends. This is because the denominator, which includes only common equity, will only fill this figure stated because PS dividends will be deducted before they are going to partake in the income generated. Again, the numerator should be consistent with the denominator. Whatever the denominator is, the investment, its total assets, shareholders' equity, or common equity, the numerator should be the profit figure that is due to them. And do not forget, average the balance sheet items, beginning and ending balance, when combining them with the income statement items in a ratio. This is for them to be consistent, to be representative of a period. Let us refer to the following case to demonstrate the calculation of the returns ratios. QET Company presented the following in the balance sheet. This is for 2020 and 2019. You have the amounts of debt, preferred shares, common shares, retained earnings, and the total liabilities and equity, which is equal to the total assets. Excerpts from the income statement also shown from operating income until net income after tax. Preferred dividends declared in the year total 1,600 pesos. Let us calculate the return ratios. Return on assets, operating profit after tax divided by total assets. Return on shareholders' equity, net income or earnings divided by shareholders' equity. Return on common equity, this is net income less preferred share dividends divided by the common equity. Return on assets. Operating profit is 22,500 multiplied by 1 minus 20%, the tax rate, all over the average assets of 130,000 and 110,000 divided by 2. Return on shareholders' equity. Numerator will be the net income, 16,000 pesos, over average shareholders' equity, 100,000 plus 60,000 divided by 2. Just exclude the assets funded by the debt portion. Return on common equity, we have net income, 16,000 less preferred share dividends of 1,600 divided by the average common equity, 80,000 plus 40,000 divided by 2. Let us proceed with our calculations. As for the return of assets, this can be simplified to 18,000 pesos divided by 120,000 pesos. As for the return on shareholders' equity, this is 16,000 pesos divided by 80,000 pesos. Return on common equity, this can be simplified to 14,400 divided by 60,000 pesos. Completing the calculations, the return on assets is 15%. Return on shareholders' equity, 20%. Return on common equity, 24%. How are we going to interpret these ratios? In this period, for every 1 peso invested by all investors, whether bondholders or stockholders, you would have 15 centavos of profits earned. In this period, for every 1 peso invested by all stockholders, preferred and common, 20 centavos of profits were earned. In this period, for every 1 peso invested by all common stockholders, 24 centavos of profits were earned. Again, these are collectively known as the returns or the return on investment. They tell us how much profits were generated for every peso of investment made by all investors, debt and equity, all stockholders, preferred and common, or all common stockholders only. Again, they measure the profitability of investment. How much profits each peso of investment earned in the said period. Let us now proceed to the last set of profitability ratios. We have earnings per share. This is equal to net income minus preferred share dividends divided by the number of shares outstanding. Book value per share. This is equal to book value of common equity over the number of shares outstanding. The shares being referred to here are the common or ordinary shares. Price to earnings ratio. This is equal to the share price over the earnings per share. Price to book ratio. This is equal to the share price over the book value per share. The latter two are called market value ratios, considering they measure the valuation of the stock, whether it is overvalued or undervalued. Sometimes we can refer to these figures. Let us refer to the following case. PRW Companies excerpt from the balance sheet shows the following figures for 2020. Preferred shares, 10% cumulative, 20,000 pesos. common shares, 1,000 stocks outstanding, 10,000 pesos. Retained earnings, 90,000 pesos. Total shareholders' equity, 120,000 pesos. Profit for the year is 20,000 pesos. Dividends in arrears, total 4,000 pesos. The stock price is currently at 144 pesos. We are to calculate the earnings per share, book value per share, price to earnings ratio, the price to book ratio. Earnings per share, we would have net income, which is 20,000 pesos, less the preferred share dividends, 2,000 pesos. Considering that these are cumulative, whether declared or not, it doesn't matter. We are going to accrue the amount of dividends that are due to them every year. In this case, it is 10% of 20,000 pesos, which is 2,000 pesos. All of this divided by 1,000 shares of common stock outstanding. The earnings per share is 18 pesos per share. If we are to distribute the net income of the company, less any preferred share dividends to all common stockholders, they would receive 18 pesos per share. Book value per share. This is equal to the book value of common equity. We will start with the total shareholders' equity, 120,000 pesos. Remove the portion that is funded by the preferred shares, 20,000 pesos. We are going to use the book value here, unless there is a liquidating value given. In that case, we are to use the liquidating value. Less any dividends in arrears that are owed to the preferred stockholders. These are the dividends that are payable to them but were not yet declared, considering there might be a lack of funds during those prior years. However, considering the preferred shares are cumulative, they should be paid before any distribution will be given to the common stockholders. All of this divided by the 1,000 shares of common stock outstanding. This will give you book value per share of 96 pesos per share. Interpretation: if we are going to distribute the book value of the common equity to each outstanding share, it will be equivalent to 96 pesos per share. Now, we are going to look at the stock price in reference to the earnings for each share and the book value for each share. Price to earnings ratio, this is equal to the share price, 144 pesos, divided by the earnings per share, as calculated, 18 pesos. 144 divided by 18, this would give you 8 times. The stock price is currently 8 times the earnings per share. Price to book value, we are to divide the share price over the book value per share. We would have 144 pesos, the stock price, divided by 96 pesos, the book value per share. This will give us 1.5 times. So the stock price is currently 1.5 times the amount of the book value for each share. The price to earnings ratio and the price to book ratio are called market value ratios. High market value ratios may be interpreted as something bad or good. High market value ratios can mean the stock is overvalued, which is a bad thing, or the company is expected to grow fast, which is a good thing. As always, context is important. In evaluating the market value ratios, we must first understand the situation that the company is in before any conclusions can be drawn on the ratios. So these are the profitability ratios. And as always, please like, share, and subscribe.
Like, share, and subscribe.